Las Vegas lost 3.1 million visitors in 1 year. Here's the part they won't tell you: they did it to themselves. A postcard from the Las Vegas Strip circa 2005 looked like a promise. Neon lights, crowds streaming through casino doors, and signs boasting $1.99 all-you-can-eat buffets. For decades, this was the city's calling card. A visitor could step off a plane, park for free at any major resort, and eat for less than the price of a movie ticket. The casino floor welcomed everyone. $5 blackjack tables lined the aisles, drawing retirees, newlyweds, and college kids into the same easy game. On the street, the buzz was about how much you could get for how little. A shrimp cocktail for 99 cents, a steak dinner for under $5. Even the parking garages, tucked behind the shimmering towers, stood open and free. No validation required. Social media threads from the era read like love letters to a city of bargains. One traveler recalls, "Imagine parking your car valet for free, walking in for a $10 buffet, and sitting down at $5 blackjack. That was the Vegas I fell in love with." These were not just marketing slogans, they were the reality that powered a record 42 million annual visitors by the mid-2010s. The Strip's business model was simple: trade razor-thin margins on food and perks for a tidal wave of guests. The more people came, the more they played. Casinos made their money not by squeezing every dollar from every visitor, but by making sure there were always more visitors tomorrow. Buffets were more than a meal. They were a show of abundance. The $1.99 price tag was a dare. See how much you could pile on your plate. $5 a hand blackjack meant anyone could play, even if they were not a high roller. Free drinks kept glasses full as long as you stayed at the tables. The sense was always that you were getting away with something, living above your means for a weekend. Las Vegas became a working-class fantasy, where the line between tourist and VIP blurred under the glow of the marquees. This was the formula that built the empire: perceived value, relentless volume, and the unspoken promise that in Vegas, everyone gets a taste of the good life. If you have ever felt like Vegas was charging you just to breathe, you were not imagining it. Stay with us, the numbers in the next section are worse than you think. Casino executives in the early 2000s understood a simple equation: the more people you brought through the doors, the more money you made. Low prices on food, drinks, and games were not just marketing, they were the engine. A $1.99 buffet did not turn a profit on its own, but it filled the dining room, kept guests in the building, and set the stage for hours spent at the slot machines and tables. The economics ran on volume, high occupancy rates, crowded casino floors, and a constant churn of newcomers trying their luck. In 2016, Las Vegas welcomed nearly 43 million visitors, a number driven by the idea that anyone could afford to play, eat, and stay like a winner. The math was relentless. Every comped drink, every discounted meal, every free parking spot was an investment in foot traffic. Hotel rooms ran at 90% occupancy or higher most years, and the real profits flowed not from the rooms themselves, but from everything that happened once the guest arrived. Operators openly described the model as a funnel: get people in cheaply, then let the odds and amenities do the rest. In industry calls, executives spoke of filling the pipeline and maximizing casino touchpoints. The Strip's margins depended on keeping barriers low and the flow steady. This approach created a culture where perks were not just for high rollers. Everyday visitors received comp points, free show tickets, and meal vouchers, reinforcing the sense that Las Vegas was a place where ordinary people could live large, if only for a weekend. The city's reputation for generosity became its most powerful asset, generating word of mouth and repeat visits on a scale no marketing budget could buy. But the seeds of change were already being planted. As private equity firms and new corporate owners began entering the market, their calculus shifted. Where legacy operators saw value in visitor volume and loyalty, the new playbook favored predictable, guaranteed revenue, often in the form of fixed fees and surcharges. The old model depended on trust that the crowd crowd would always return. The new one wanted certainty, even if it meant fewer guests. If you have ever felt like Vegas was charging you just to breathe, you are not imagining it. Stay with us. The numbers in the next section are worse than you think. By 2019, the Las Vegas Strip had quietly rewritten the rules of the game. The days of free perks faded as hotels introduced a new layer of mandatory charges, resort fees, parking fees, and service surcharges that were impossible to avoid. The average nightly resort fee, once a minor footnote, climbed from $36 in 2019 to over $40 by 2025. That figure is only the starting point. At flagship properties like the Bellagio and Aria, guests now face nightly fees of $50, $55, or more. For a 3-night stay at one of these premium resorts, a visitor can expect to pay $165 in resort fees alone before ever touching the slot machines or ordering a drink. Parking, once a free and unremarkable amenity, became another income stream. By 2025, self-parking at most major strip hotels costs between $15 and $25 per night. Over a standard long weekend, that is an extra $45 to $75 tacked on to the bill. Even the most basic conveniences, Wi-Fi, gym access, bottled water, are bundled into these charges or sold at a premium. A single bottle of water from a minibar can reach $26, while a specialty coffee at a casino Starbucks now runs $12. Industry surveys from 2019 through 2025 show a relentless upward march. The average resort fee increased by more than 11% in just 6 years, outpacing inflation and far exceeding any rise in the base room rate. At the top end, the Strip's most expensive hotels have pushed resort fees past the $50 mark, setting a new standard for what qualifies as luxury. The cumulative impact is hard to ignore. For many guests, a 3-night stay at a mid-tier hotel now brings $120 to $180 in unavoidable fees on top of the advertised room rate. At the high end, the total can easily exceed $200. These are not optional extras, they are the cost of entry. The city that once prided itself on value has become a master of extracting every possible dollar from each visitor, whether they win or lose on the casino floor. If you have ever felt like Vegas was charging you just to breathe, you are not imagining it. Stay with us. The numbers in the next section are worse than you think. A single cup of coffee on the Las Vegas Strip now costs $12. Not at a high-end restaurant, but at a Starbucks inside a casino. The sticker shock does not end there. A bottle of water from a minibar can run $26, and a quick breakfast for two. Once a cheap ritual, now routinely tops $40. These are not isolated cases. They have become symbols of what many visitors call nickel and diming, a phrase that has moved from travel forums to mainstream news. In the past, small purchases blended into the background. Now they stand out as reminders that every amenity comes with a premium. Guests share receipts online, tallying up the cost of a weekend that spirals far beyond the advertised room rate. A family on vacation posts a photo of their $12 coffee, the image ricocheting across social media with thousands of comments echoing the same complaint, that Vegas just is not worth it anymore. The backlash is measurable. In early 2025, a poll of 15,500 travelers found that nearly 90% believed Las Vegas had become too expensive for tourists. The methodology was straightforward, random sampling across age and income groups with a single question: is Las Vegas still affordable? The answer, overwhelmingly, was no. Complaints are not limited to food and drink. Parking charges, service fees, and mandatory resort fees have turned every transaction into a negotiation. Guests report feeling ambushed by hidden costs at every turn, eroding the sense of value that once defined the city. This pattern is not accidental. Operators have chosen to extract revenue from every possible angle, trading loyalty and goodwill for short-term certainty. The result is a city that feels less like a playground and more like a paywall. If you have ever felt like Vegas was charging you just to breathe, you are not imagining it. Stay with us. The numbers in the next section are worse than you think. In May 2025, the Federal Trade Commission stepped in with a rule aimed squarely at the heart of the Las Vegas pricing model. The regulation, known as the junk fee rule, requires hotels and resorts to display the full all-in price, including every mandatory fee, up front before a guest can book. No more burying resort charges in the fine print or tacking on surprise fees at checkout. The FTC's language is blunt. Any unfair and deceptive hidden fee is now a violation of federal law. For the first time, consumers are granted the right to sue hotels that fail to comply, and the penalties can climb into the tens of thousands for each infraction. The rule applies nationwide, but its impact lands hardest in Las Vegas, where the difference between the advertised price and the final bill has become notorious. Casino operators can no longer rely on the old playbook, advertising a low nightly rate, then inflating the total with resort fees, parking charges, and service surcharges. Every dollar, every fee must be shown before a guest clicks book. This is about transparency. This is not a ban on fees. The rule does not stop hotels from charging for amenities or packaging services as they see fit. What it does is force transparency. The days of luring visitors with bargain rates only to ambush them with hidden costs are over. In effect, the federal government has acknowledged what millions of travelers have complained about for years. The Las Vegas pricing model crossed a line. Casino executives now face a dilemma with no easy exit. Dropping fees risks immediate revenue loss and shareholder pushback. Keeping them risks further alienating the very visitors the city depends on. The numbers show that the crisis is not a matter of bad luck or outside forces. It is the result of deliberate choices. Choices that have finally drawn the attention of regulators. If you have ever felt like Vegas was charging you just to breathe, you were not imagining it. Stay with us. The numbers in the next section are worse than you think. Las Vegas recorded 38.5 million visitors in 2025. That is the lowest annual total since 2010, and it represents a loss of 3.1 million people compared to the pre-pandemic baseline. The city that once counted on relentless volume, crowds streaming through every casino and restaurants packed at all hours, now faces empty seats and shorter lines. The Las Vegas Convention and Visitors Authority's own numbers confirm the decline, with each year since 2023 chipping away at the total. For a city that built its fortune on the idea that more was always better, the reversal is stark. This is not a blip or a post-pandemic aftershock. The drop follows years of rising fees and mounting complaints, not global events or outside shocks. In 2019, Las Vegas welcomed over 42 million visitors. By 2024, the figure had already slipped to just over 39 million. The 2025 shortfall is not just a statistic, it is a warning. Each missing visitor represents a lost hotel booking, an empty seat at a show, a slot machine sitting idle. The Strip's business model was always about filling the pipeline. When the crowd shrinks by millions, the entire system feels the strain. The numbers show a clear pattern. As the cost of entry rose, the crowd thinned. The feedback loop is visible on every quarterly report and in every empty seat. Operators can point to higher daily spending among those who still come, but overall volume is falling. The promise of affordable escapism, the very thing that made Las Vegas a mass market powerhouse, has started to unravel under the weight of its own pricing decisions. MGM Resorts reported $2 billion in Strip revenue for the third quarter of 2025, a 7% drop from the same period a year earlier. Room occupancy across their properties slipped to 78.9%, a figure that would have sounded unthinkable during the city's volume-driven heyday. Revenue per available room, the industry's core profitability metric, fell 7.6%, even as daily rates and fees continued to rise. The shortfall was not isolated to one operator. Caesars Entertainment saw a 6% contraction in gaming revenue, and Wynn Resorts posted a 5% decline in overall property revenue. Public filings and earnings calls echoed the same refrain: fewer guests, shorter stays, and a shrinking pipeline of new bookings. Segment data revealed the losses were not evenly spread. Canadian visitors, once a reliable source of off-peak demand, contracted by nearly 20% between 2019 and 2020. 2025. Airline capacity reports from WestJet and Air Canada confirmed the pullback, with fewer flights, emptier planes, and a steady erosion of cross-border tourism. European travel agencies reported a similar hesitancy, citing the city's fee environment as a primary deterrent. The average length of stay fell from 4.2 nights in 2018 to just 3.1 nights in 2025, even as daily spending ticked upward, $158 per day, up from $135. The total revenue per guest lagged behind, unable to offset the loss in volume. The numbers on the balance sheet left little room for spin. Operators had succeeded in extracting more money from each remaining visitor, but the crowd was thinning. The city that once ran on relentless volume now faced the reality of empty rooms and idle tables. The steady drip of lost guests translated into hundreds of millions of dollars in foregone revenue, a hole that even the most creative fee structures could not fill. In boardrooms and on investor calls, the language shifted from expansion to mitigation. The bottom line, casinos traded long-term loyalty and word of mouth for a short-term revenue fix, and the bill had come due. Bill Hornbuckle, Chief Executive Officer of MGM Resorts, addressed shareholders in the fall of 2025 with rare candor. He admitted that they had lost control of the narrative over the summer and said he thought everyone would agree to that in hindsight. Hornbuckle singled out public anger over $26 bottles of water and $12 coffee and conceded that high resort fees had become a point of real friction for price-sensitive guests. Tom Reeg of Caesars Entertainment took a different tack, insisting during 2026 investor meetings that there was no crisis, even as the company's share price languished at half its previous value. The industry's public face split between acknowledgement and denial, but the numbers left little room for comfort. In a move that set it apart, Resorts World Las Vegas announced a summer of 2025 waiver of all resort fees for guests staying 3 nights or more. The gesture was billed as an attempt to restore visitor confidence, but no other major operator followed suit. The city's largest players now faced a stark choice: drop the fees and risk immediate revenue loss, or keep them and watch the crowd keep thinning. FIFA's arrival in 2026 is projected to bring up to 4 million extra visitors to Nevada, with Las Vegas cast as the entertainment capital for the tournament. WrestleMania 42 promises another 250,000 fans, each event offering a short-term surge in room bookings and casino traffic. UNLV's tourism forecast points to a rebound, 40.1 million visitors expected in 2026, nudging the city back toward its pre-pandemic levels. Yet the optimism comes with a catch. Mega events have become lifelines for the Strip, but their impact is fleeting. Each one triggers a familiar cycle. Nightly rates spike, parking fees climb, and even the price of bottled water can reach $26, a receipt that has become shorthand for everything wrong with the new Vegas. The hope is that crowds will return for the spectacle, but the underlying math has not changed. Temporary windfalls cannot mask a deeper problem. A city once built on affordable fantasy now relies on one-off events and price hikes to fill the gap left by millions of missing regulars. Today, the Strip faces a stark choice: drop the fees and risk the bottom line, or keep them and risk the city's soul. Chief executives admit the math no longer adds up, yet the cycle continues. Vegas was built on volume, not extraction. The paradox remains unsolved, and the stakes are higher than ever. Let me know in the comments, does Vegas still feel like a gamble worth taking?